Okay, we're good.
All right. So first, I want to welcome everybody to our weekly webinar on out-of-state investing. Even though we have this each week, it's a little bit different according to the participants and what information um, they want to know. And so I've got a couple of short presentations. One is more generic about out-of-state investing in general. The second one goes more into specific about why Detroit and why use the BNIC Network LLC to manage real estate deals on your behalf. And then the last has to do with our current offering that we have where we're selling equity in one of our clients' LLC that owns a turnkey rental property in Detroit. During the presentation, feel free to raise your hands to ask any questions. I won't be able to see that you've raised your hand, but Stefan will be able to see it, and then he'll be able to interrupt me. We'll pause, address any questions. And then after each brief presentation, we'll also have a Q&A. I want this to be as informational and as helpful to you guys as possible. So with that in mind, let's go ahead and get started. And so the very first presentation is just about out-of-state real estate investing, and which I believe is a strategic approach for enhanced returns. So first and foremost, who am I? So I'm the president of a couple of companies, Help Keep My Money LLC and the BNIC Network. I graduated from Loyola Marymount University in Los Angeles with a degree in economics. I've got over 30 years of developing and managing complex operational and financial systems in the hundreds of millions of dollars. I also spent 4 years as the CFO for Santa Barbara County's mental health department, where I developed and managed a $106 million annual operating budget. I spent 2 years as a contract CFO in Santa Barbara, working for a nonprofit where I managed an $11.5 million endowment fund. So I've got a lot of experience managing millions of dollars, mainly for rich white liberals. So we're going to cover a couple of things. So we're going to start with the basics, which is some real estate investment basics, which I believe are the two important things that a real estate investor should focus on. The cash on cash return, expressed as a percentage of your investment, and then your cash flow. And then we're going to talk about what are the advantages of out-of-state investment opportunities. So I will start with a video, and Stefan, you just tell me whether or not you'll be able to hear the sound.
You just said that the current share is in the presenter.
Right there.
So you can't hear the sound?
I can hear the sound, but I'm not entirely clear.
It's a little faint though.
Can everybody else hear the sound?
Not very well.
Not very well. Oh, that sucks. Let me see something. Hold on. Let me first get out of here. And let me see. Maybe something that I need to do on here. Okay. I think hopefully that will solve it. Share this out. Now if I get back in to the presentation mode, just not allowing me to. There. Share for a minute. Let's try this again. So,
I oftentimes say when I'm talking about real estate deals, I often say I'm looking for two different metrics that I care about more than anything. So one of those is called cash on cash return. All right, cash on cash return. The other one is just total cash flow. Don't mind my terrible handwriting. So those two things I care about more than almost anything else, right? Which makes sense. So cash and cash return is what percentage of my investment am I making back every single, what percent of my money am I making back every single year in profit from the cash flow? And cash flow is like a dollar amount. How much per month am I actually making? Now, I oftentimes say that cash on cash return, I aim for a 10 to 12%. That's what I want for a cash on cash return. And I aim for between $100 and $200 a month in cash flow per unit. Now, the question was that I just got on a webinar is, what if the actual dollar amount looked pretty good, like achieved, like let's say I was getting $200 on a single family house, we'll call it, right? Let's say I was making 200 bucks, but I was only getting a 5% return. Would I do that? Great question. So here's how I look at that. If I'm just getting started and I'm trying to buy my very first deal and I'm only getting a 5% return, and I know that I'm gonna have more money where that came from, I would probably do it just to start building momentum, as long as I was really confident in that number. Because I believe in the beginning, momentum is more important than your actual return on a single investment, the knowledge and experience you gain. Now that said, I would normally say the cash on cash return number, the percentage, is more important than your dollar amount. Now, why do I have two of those numbers? It's because without using both those metrics, you can manipulate it. For example, what if I had a property that was making me $200 per month, but that fits my metric, right? But it cost me $10 million to buy that property. That would be a horrible deal, right? So that would be a super low, like a 0.0001% cash to cash return. Now, on the other hand, what if I had a property that was giving me a 50% return on investment? Whoa, that's really good. But that just might mean I put $2 into the deal because it was almost a no money down deal, and I made back only $1 the entire year. I was making back like 8 cents a month. That's a horrible deal, right? I don't want to make 8 cents a month. That's why I want both these things. Now, generally speaking, I care more about my percentage return than I do my cash flow number, but I would like to have both those hit my metrics. But again, I would be willing on an early deal just to build momentum to go a little bit lower than that. So hope that helps answer that question. If you enjoyed this video, make sure you give me the thumbs up below the video. And I guess follow me, us, Bigger Pockets, on everywhere at Bigger Pockets, and me personally at Beardy Brandon over on Instagram.
So let's focus on the first thing you said about cash on cash ROI, and why investing out of state can give you a higher cash on cash ROI. So he defined what the cash on cash ROI is. So mathematically, it's when you take your annual pre-tax cash flow divided by the total cash invested, and you multiply that by 100. So let's use two examples. So I'm in California, and I'm in the Antelope Valley, where you can buy a home for about $500,000 and the rent's for around $3,000 a month. So if you were to buy this house using a loan of where you put 20% down So that's $100,000 in closing costs. Just add on another 10. So you're in for around $110,000. So that'd be your total cash invested. Well, let's look at what your annual pre-tax cash flow is. So you got your rent at $3,000, but the mortgage itself is almost $2,700 a month. And we haven't even taken into consideration operating costs, which are going to be your property management costs, which are typically 10%. So in this instance, that'd be $300. Your insurance, as well as your property taxes. So in this situation, your cash on cash, your annual cash flow is going to be negative. And as a general rule, we don't do nothing negative, right? So, and that's one of the problems here in California and usually along both coasts is that you cannot usually make properties cash flow. They just don't, the numbers don't work. So let's look at an example in Detroit, where we've got a $48,000 home that we pay all cash for, a couple $1,000s in closing costs, so we're all in for $50,000. Well, that house will rent for around $1,000 a month, and they'll have operating costs of usually around $300. But to make the math easy, I said it's going to be $375, so that your monthly cash flow is $625 a month, but your annual cash flow is $7,500 a year. Now, when you take that $7,500 and divide it by the $50,000 in cash, now you're at a 15% cash on cash ROI. And if you look back at the video, he recommended that you should target, low double-digit returns, 10 to 12%. Well, here we're sitting at 15%. So that's going to be the first benefit of investing out of state, is you're going to definitely get that higher cash on cash ROI when you're investing out of state in the Midwest. You also have lower cash investments. So these are the median house home prices in California, Florida, and Texas. So 860,000 in California, 415 in Florida, and 340 in Texas. Again, we're going to assume another 20% down, 2% for closing. And so in California, you need about $200,000. Florida is around 100,000, and Texas is around 75. In Detroit, again.
Quick question is now do you want to wait for the end for questions, or can I ask one now?
Yeah, go ahead.
All right, perfect. For that formula you just showed for cash on cash return, do you include, I saw down payment in there and also closing costs. Do you include any cost for repairs or updates in that number as well too? Or no?
Yes, any out-of-pocket cash, right? So according to how your deal is structured, you may finance the rehab, especially if you're in California. That $500,000 may be acquisition and rehab. The same for Detroit. That $50,000 of total cash invested, that's for the acquisition and the rehab.
Thanks.
Sure, no problem. So we go back to looking at how much cash you need in each state. In the city of Detroit, in the market that we deal with, $50,000 is all in. So then the question becomes, well, what can you get for $200,000? So in California, you can basically get one house. Let's say it rents for around $4,000. And so you get $4,000 a month minus whatever the mortgage is and the operating costs. In Florida, you can get around two houses, and you'll generate around $3,000 for each house. So you get about $6,000 a month minus the mortgages and the operating costs. And in Texas, you wind up spending about 150,000 to get two houses. So that's $4,000 a month, plus you'll have $50,000 in cash left. But again, you got to minus the mortgages, the operating costs. In Detroit, you're going to get four houses, $4,000 a month with no mortgages. And so a significantly lower cash investment allows you to be able to get in and achieve these higher ROIs. Now, when you are dealing with out of state, you are going to have some better money management tools. You're going to definitely need to have reliable boots on the ground and someone who can manage your portfolio. So if you're building a portfolio of many homes, you may have a single property manager, you may have multiple property management companies, but you're definitely going to need great boots on the ground that you can trust. And unless you're going to manage your portfolio, then you need to have somebody who has the experience and has the systems in place, which is the next thing. Whoever you're dealing with needs to have good systems in place. They need to have a good system for identifying good properties, for negotiating the best prices, for identifying the best rehabbers and negotiating prices with them, systems for identifying property management companies, and the property management company has to have a good system for identifying and locating great tenants. And so this is all about systems. One important system is communication. You got to have great communications with everyone who's involved, okay? And so you can use some technology, right? So there's, Zoom is a great technology for being able to interact with your boots on the ground, to be able to see live in person how properties look, those type of things. But there's also what they call prop tech, other property management technology that you can also use. And then you want to make sure that you're looking at your metrics, okay? And markets in the Midwest have better financial ratios. So we've talked about the cash on cash ratio, but the next ratio you really want to concentrate on is rent to price. That's the monthly rent divided by the sales price. And so this is as of May. These are the markets based on Zillow data that have the best rent to price ratios. Again, you take the average monthly rent divided by the median sales price. The higher the percentage, the better off that property in that market will generate cash flow. And so the number one market in the United States when it comes to rent to price ratio is Jackson, Mississippi. And then you've got Montgomery, you got Baltimore, Toledo, there's Detroit, Cleveland, Shreveport, Dayton, Kansas City, and Peoria. Well, what you will see, all of these are in the Midwest or in parts of the South. And so traditionally, and I mean for the last decades, the Midwest has always been the best cash flowing markets, while the coasts have been the best appreciating markets. That changed here within the last couple of years. Detroit was actually the best appreciating market in January of this year. And in the market, or the segment of the market that we focus on, which is the lower part of the value chain, again, $50,000, 3-bedroom, 1 bath, 1,000 square foot in the hood of Detroit. 3 years ago, that typical house we could have bought and rehab for $25,000, and it would have rented for $500, and it now is $50,000 and rents for $1,000. So in 3 years, double in value, double in rent. And I'm not aware of any other market in the United States that has done that. So we're in a unique position in Detroit to have both great cash flow, great future appreciation, though nothing is guaranteed. And then it's just the size of Detroit. Detroit is bigger than all of these cities, not just in population, but in the available properties, vacant lots and boarded up homes and those type of things. Now you will need better risk management tools. One of the things that can easily happen is because it's out of sight, it can be out of mind, and you don't pay that close attention to it. Okay. Also, and my personal opinion dealing with Detroit since 2020 is it's very easy to get hustled, specifically in Detroit, but just in general, when you're an out-of-state investor, especially if they see that you come from California or from New York, and their eyes get all, bright and wide open because they see that money, right? And so it's easy to get hustled, and sometimes you won't even know that you're getting hustled. So you want to do your due diligence, and it goes back to, again, having the right boots on the ground. Diversification as a risk management strategy. So we just use that example of $200,000 gets you one house in California. It gets you 4 houses in Detroit. If your deal in California goes bad, then now all of your money is at risk because you put all your money in one basket. Versus if one of your deals in Detroit goes bad, 1 out of 4, you still got 3 that are performing. So diversification definitely becomes a risk management strategy. You want to understand the regulations of what you can and cannot do in each state, the processes, as well as understanding which states and areas are landlord friendly versus tenant friendly. Detroit, because of COVID, has really turned into more of a tenant-friendly legal system. And so because of that, you need to make sure that your property management company has changed some of its techniques. So for example, the property management company that we deal with, Great Lakes Property Management, does not recommend entering into any annual leases unless it's Section 8. If you're dealing with cash paying tenants, just do those month to month. And the reason being is because the time to evict and the process to evict a lease, a 1-year lease tenant, is extremely long with the courts. And so those are things that you need to investigate. And then of course you want to make sure that you've got insurance, because what insurance does, it shifts risks. And then you want to make sure that you also set aside reserves out of your net operating income on a monthly basis. You want to do that to cover maintenance costs, a vacancy rate, so that when your property does become vacant and you need to turn it over, which means now you need to make it presentable again. You may need to paint, you may need to do something with floors, that you've got money set aside for that. And then CapEx expenditures. And CapEx is short for capital expenditures. Those are expenditures for items that last longer than 1 year. So a roof, air conditioning system, furnace, hot water, electrical, plumbing. You want to set aside money each month into a reserve account from your net operating income. And then how much of a reserve is based on each investor's risk tolerance. And so that's the end of the first presentation, in which we went over the real estate investment basics, right? Cash on cash ROI, which is king, and then looking at your cash flow, and then the advantages and strategies of out-of-state investments. And so I'm going to take this time real quick to see if there are any other questions that you guys have before we move on to the next.
Just raise your hand and then I'll unmute you.
Going once, going twice. All right, then we will jump to the next presentation. So let me get that one more.
That's a question.
Oh, there's a question?
Hey, Michael, I thought that was a really, really great presentation. For the rent to price ratios, what was your sourcing for that? Where did y'all use those numbers? How did you get to those?
Sure. So we use Zillow's historical research information. Zillow has a plethora of free data that they offer on information through their platform. And so you can get historical sales prices, you can get historical rent prices. And so that's what we use. We use Zillow's information.
And then for just building your team on the ground, are you from the Detroit area, or how did you go about building your team?
Sure. I'm born and raised in California. Had never been to Detroit before last July, and it took me 2 years to build the team on the ground. I went through several iterations, and it's about developing relationships, right? People that you know, people that you trust. During COVID, people of my generation jumped on Facebook. And so there are a lot of Facebook groups dealing with real estate in Detroit. And so I was part of those groups. I interacted with the people on those groups, got to know them. And so that's how I found Clarence Archibald. He is he leads the family-run company, Great Lakes Property Management. They're a full-service real estate company, been in business since '06. So they went through the '08 turmoil. They manage over 300 rental properties, mainly for out-of-state investors. And of those 300 plus homes, 40 are owned by his family, with his family portfolio. And it was, I mean, with our first property, we used another property management company because at the time Clarence was on vacation, and I wound up firing that property management company because they tried to nickel and dime me, right? And then I wound up going to Clarence, and Clarence joked at me because he said you should have just waited till I got back off vacation. And we learned a lot of lessons with that first house because we use a risk management system that I developed. And it's a computerized system that tells us deal or no deal, but it's also a set of procedures and processes. And with that first property, a lot of things that could go wrong went wrong, but the risk management system managed that risk. And so even though almost everything went wrong, we were still able to generate almost a 15% cash on cash return. And that's the power of the risk management system, right? It's a worst case scenario system. And this first deal was like the worst case scenario and getting this turnkey rental property up and running. But we bought it in and I'm gonna talk a little bit more about that specific property when we get closer to the end. And so we'll cover that then. Any other questions before we move on to the next one? All right, so let's jump back in here. Why this is not slideshow. Okay. All right. So now that you've got some education about um, why it's beneficial to invest out of state, let's talk about um, how to become. All right. We've talked about the why, and let's talk about specifically why Detroit. So I state that Detroit is the best single family rental market in the United States. So you saw that it was number 5 on the rent to price ratio, but it's beyond that. And because that data was at the zip code level, actually it was beyond the zip code level. That was at called the MSA label level, metropolitan statistical area. So it takes a group of zip codes, right? But I can tell you, because we've zoned in about 4 or 5 zip codes, that there are some specific zip codes and neighborhoods in Detroit that far exceed most other areas and markets throughout the United States. There's also just a sheer number of available properties. There are 70,000 vacant lots and boarded up homes that are owned by one legal entity called the Detroit Land Bank Authority. It's a government agency. And again, by themselves, they own 70,000 vacant lots and boarded up homes. And so there's probably about another 10,000 that are in private hands. There's no other market in the United States that has that many vacant lots or boarded up homes. And so because there's such a large supply, it means that you don't have to, but that means you can cherry pick. Okay. And that's what our system is actually made to do. We can put forth 100 properties into our system, and 2 might pass our initial screening, right? But we are extremely picky. That's how we manage risk. That's why we take the subjective nature out of this as much as possible. And then there's just not enough Section 8 houses, and that's what we do. We create turnkey Section 8 rental houses. Now, at the same time, it's one of the fastest appreciating real estate markets, right? Detroit has a brand new downtown, brand new riverfront. After 66 consecutive years of population decline, where the population at one time was around 2.5 million in the 50s, and now it's a little bit under 700,000. In 2023, Detroit had its first increase in population in over 66 years. So the Detroit market has bottomed out. Okay, it probably actually bottomed out a couple of years ago, just by the fact that, you know, you could have bought and rehabbed the house for 25,000, and now that cost is now 50,000. So it's bottomed out, and because we are at the bottom of the value chain, there is no place to go but up. Okay, and for those that are in Los Angeles, I compare current inner city of Detroit to the inner city of LA in the late 90s after the 92 riots. And for those in Los Angeles, all we've seen is gentrification, gentrification, gentrification. And so that has not happened in the hood in Detroit yet. And so we have an opportunity, specifically as Black folks, to go into the inner city of Detroit to stabilize the rents, because again, the rents have doubled in a few years, right? To stabilize the rents and to keep the majority of the city of Detroit Black owned, Black controlled, and to rebuild it. And so it's a unique opportunity, and we can use Detroit as our template for doing other cities throughout the United States. So why work with us, the BNIC Network? So we manage all aspects of the real estate deal. So whether you want to be 100% passive or whether you really want to be involved and you want to fly out to Detroit, you know, look at houses and you want to be involved in everything, we again manage everything for you. You have 100% control over your money. That's what we do not do. We do not spend your money. We will give you submit payment requests for you to pay the contractors, to put money into escrow, to do these certain things, but we do not control your money. You always control your money, right? We are your consultants. And so we make recommendations, we make requests, but you always control 100% of your money. The entire process from the close of escrow to acquiring a tenant is typically 3 to 6 months. And the way that we make money is two parts. We charge 2%, basically to cover our costs during the process. So 2% of the purchase price, 2% of the rehab costs, and if we sell it within our network, 2 to 4% of the sales price. But we make the majority of our money on the back end. So we give you what's called a preferred rate of 10%. Basically saying any profit that's made on the back end, whether from selling the property, selling the equity in the property, or from holding on to the property and making money through renting, you get to keep 100% of the profit up to 10% of your investment. So you invested $50,000, you get the first $5,000. Everything after that is then split 50-50. All right, so we have two classes of investors. We have a traditional investor and a retail investor. Traditional investors are those who are used to buying distressed properties, rehabbing them, and then either adding them to their portfolio or flipping them. So as a traditional investor, again, we create turnkey rental investments on behalf of the investor. Investor needs $50,000, plus we recommend another $5,000 for contingencies. So $55,000. We just talked about the preferred ROI of 10%, and anything greater than that gets split 50-50. And so what we shoot for is off of a $50,000 investment, we look to bring back $75,000, turn the 50 into 75,000. So if we do that, that's a $25,000 profit. First $5,000 the investor gets to keep, which leaves $20,000 to split. We get 10, investor gets 10, 5 plus 10 is $15,000. So a traditional investor would typically earn $15,000 on their $50,000 investment. That's a cash on cash ROI of exactly 30% over a 6-month period. And then what we recommend in order to build generational wealth, to build a portfolio, is you take that $50,000 that we return to you and you do it again so you can generate another $15,000. So in 1 year period, you should be able to do at least 2 deals with the same $50,000. And that's a 60% ROI. That's without using any leverage or loans. That's just strictly cash. And we always look at things from the worst case. If for whatever reason we're not able to sell the property, we're not able to sell the equity, and you just have to hold on to it, the very worst case is you're going to make an ROI of at least 15%. So now the other type of investor we have is a retail investor. So the retail investor is a person who purchases the turnkey rental property after it's been rehabbed, after it's had a tenant in it, and it's after it's already performing and generating income. So if a retail investor purchases the property, the next month they're going to get money into their account. So there's two ways that a retail investor can purchase. They can purchase the whole property. And if they're a part of our network of investment clubs, they'll get it at a 10% cap rate. If they're not part of our network of investment clubs, they'll get it at around a 9% cap rate. So for a property that generates $7,500 a year, 10% cap rate means we sell that for $75,000. 9% cap rate, we sell it for around $84,000. The other option is that retail investors can purchase parts of the company that owns the property, right? We put every property to an LLC. And you'll earn a cap rate currently around 8.5% per year. But minimum investment is only $500, right? And you can buy it in $100 increments above that 500. And you make money each year because you get a fortunate share of the net operating income paid out on a quarterly basis. And then when we sell the property, you still get money on the back end. And so I use this example of if you invest $1,000. If you invest $1,000, you're going to get $85 during year one, $85 during year two. We are looking to hold these properties typically for 2 years, because after a 2-year period and the property is performing well, now when we go to sell that property, we're going to lower our cap rate, which is going to increase the price. So if we lower our cap rate to 7%, then that means the property will sell for around $108,000. At that amount, when we sell it, the limited members who get in will make a return of around 25% on the back end, which means they'll make another $250. So when you add up over a 2-year period, $85 in year one, $85 in year two, $250 upon the sale, that's $430 over a 2-year period. That's a 43% return. That's over a 21% return per year. And again, it doesn't matter whether you invest $500 or you invest $70,000 doing it this way, the ROI is the same. And so that's why we say the ROI should be the #1 thing that you look at. And then, so that ends this presentation. And are there any questions? I know I ran through stuff pretty quickly, so. Anything, anyone?
One high level question, Michael, for you. You talked about Detroit's growing population. From your perspective, what do you think at a macro level is driving that, or would continue to drive that?
Oh, yeah. So let me give you a little bit of a little more history about Detroit. So in 2013, Detroit filed the largest municipal bankruptcy at that time. Okay. And then they came out of bankruptcy, I think it was the end of 2014, 2015. And their planning department created a plan to rebuild Detroit because Detroit had hit a low by filing bankruptcy, right? Well, here comes President Trump. And in 2017, he signed the Opportunity Act that created opportunity zones. And opportunity zones have great tax benefits for real estate investors who hold property in an opportunity zone for 10 or more years. And Detroit had basically designated all of their downtown area as an opportunity zone. And the owner of the Cavaliers came in, and with the help of the planning director of Detroit, who quit his job and opened up these opportunities funds. He opened up $150 million worth of opportunity funds because he knew where all the development was going to go. And so, they came in, bought properties, pennies on the dollars, and then, rebuilt all of downtown Detroit, rebuilt all of the riverfront, started bringing in more businesses. The Detroit auto industry got revived because of electric vehicles. Okay. And what happened is the development went well. So there's a whole movement throughout the United States that people who work downtown want to live close to where they work, right? And so they started gentrifying the areas right around downtown, right? They also jumped beyond 8 Mile, where the suburbs are, and started playing out there. And there are some small patches here and there within the city of Detroit, but that they started redeveloping, but nothing cohesively yet. And so it's a unique opportunity where a city has bottomed out, right? And there's a saying in investing, period. You make money on the buy. When you buy an investment, that's when you make your money. You got to buy it right? And so when you look at all the things and you look at the risk, there's very little risk of buying in the hood and creating Section 8 housing, right? Because the worst case, and we built our model based on if we have another 9/11 where the financial markets tighten up and you can't refinance, right? If you're taking out hard money loans, you can't refinance, or another 2008 where the market values plummet. That was our model, right? We say, hey, if we've got these hard money loans and we can't sell the properties, we are forced to hold them and rent them. We got to be able to rent them enough to cover our hard money loans. That was the hypothesis. Well, COVID came in, and no one ever thought of that there'd be a time where you could own a property, have a tenant in, and you could not evict the tenant for non-payment and replace them. No one ever imagined that. And so a lot of small landlords got wiped out because they still had to pay their mortgage, but they couldn't get any rent, right? No one built up reserves for that. Let me say that. All right. Unless you was a huge company that had huge reserves, you didn't plan for that. And so one of the ways we manage that risk now is third-party government payers, Section 8, VA, social services, right? That's who we focus on. And so everything is lined up. And I tried to get people to invest in this in January of 2021. And no one really saw it. And so now what's happening is you got a whole bunch of people starting to rush into Detroit, but you still got to have good boots on the ground, or else you're going to get hustled.
And one other thing you mentioned too that I thought was interesting, I don't know if I got the numbers exactly right, but you mentioned like the city of Detroit or some entity there owns like 70% or 70K of vacant lots, and then the rest are privately owned. Could you just say that one more time just to make sure I heard that correct?
Sure. There are 70,000 vacant lots and boarded up homes that are owned by one entity, the Detroit Land Bank Authority. That is a government agency that was established by the city of Detroit to manage all of these vacant lots that they have. So you have to understand. So as the economy of Detroit was going down over the years, what the politicians did was, oh, we're losing our revenue base. So let's increase property taxes. Well, you increase property taxes and now people can't pay their property taxes. And so they default and they just, they just made it worse. But they had all these vacant houses. And so some of these vacant houses turned into crack houses, right? Stash houses. So they started knocking houses down.
Gotcha.
Because it was more efficient to have a vacant lot than to have a boarded up home.
Yeah. And are they redistributing these homes like via some type of auction, or is that
So you can go online right now to the Detroit Land Bank Authority's website. With your credit card, you can bid to buy a house for $1,000, right? And they've got some standing inventory, but these are the worst of the worst. Okay. Also, what a lot of people don't know, if you own a property in Detroit and next to it is a vacant lot that's owned by the Detroit Land Bank Authority, you can buy that lot for $100. Okay. So at one time, the Detroit Land Bank Authority had 100,000 vacant lots and boarded up homes. Now they're down to around 70,000. And so it is a unique opportunity for us to take California money, go into Detroit, buy up properties, build these turnkey rental properties, focusing on Section 8 because there's not enough Section 8 housing. And what that will do is we can stabilize neighborhoods, we can stabilize rents because there's enough meat on the bone for everybody to eat, right? We don't need to come in and keep pushing rents up, right? And pricing out the people who have traditionally lived there. No, we can go in and we can keep it black. And we can keep it to where the people who traditionally live there can continue to live there while we rebuild it. Yeah. Our philosophy is we go into C-class neighborhoods, we build B-class properties in order to attain and retain A-class Section 8 tenants. Okay, we've got a couple of marketing strategies of how we get good Section 8 tenants in there. And so let me talk a little bit more about the first property that we've done. And let me share my screen again.
I'll unfortunately have to drop, but thank you so much, Michael and Stefan and Sally as well. Have a great rest of the call. Thank you all.
All right. Well, thank you for coming.
Me too.
So our first property was 17917 Mackey Street, and had a client from Los Angeles. She had never owned investment property in her life. She's never been to Detroit, but she put her faith in me and my company. We identified a couple of other properties and we were going through our process. And as we took the onion back on these properties, we found problems. And so because of the processes that we use, we were able to back out without her losing any money other than the money for, the $500 for doing a property inspection. But she closed on this property in March of 2023. It came with a tenant. The tenant originally agreed that she was going to stay. She was going to sign a 1-year lease and all this other stuff. When we closed, she didn't want to pony up any money, so we had to evict. Okay. And then the property management company was nickel and diming us, so we had to get rid of the property management company. When we did the slight rehab, it wound up being a lot more. Well, I mean, a lot is relative. I thought it would be, around $5,000 or $6,000. It wound up being around $11,000 for the rehab. And then once we had rehabbed it, I tried to price it at $1,000 a month. Property management company was like, Mike, we think we can get like 900. I was like, oh, let's try 1,000. And so we tried it for 2 weeks. lots of applicants, but none that were qualified based on the property management company's criteria. Then they lowered it to $950 for 2 weeks, still nobody. And so when we lowered it to 900, we got a Section 8 tenant, but Section 8 only wanted to pay us $866. So let me tell you how that played out. Section 8 issues vouchers based on bedroom size. And so this person had a 1-bedroom voucher, and Section 8 said they would pay $866 for the 1-bedroom. Our property is a 2-bedroom. And so we took the 1-bedroom voucher, which allowed the Section 8 tenant to get a 2-bedroom. This is one of the strategies, because now that Section 8 tenant values having a 2-bedroom versus the 1-bedroom, and therefore values the relationship that we have and doesn't want to mess that up. Okay. The other thing is Section 8 pays 100% of the rent. Now, you'll have some people say, well, you should have you should look for a tenant that pays a little something toward it. I totally disagree. If you can get a tenant where Section 8 pays 100% and you're not chasing anybody each month, why wouldn't you? On the first of each month, the Detroit Housing Commission sends a check to Great Lakes Property Management. They got 10 days to reconcile their books. They send us a statement on the 10th of the month, and on the 11th of the month, they direct deposit money into my client's business account. And it's been going like that since February. Now, one thing you do have to understand, it's government, takes them a little slow to get started, but they always go back to the beginning of the contract. And so our first payment was in February, and it covered part of November, all of December, all of January, and then it paid for February. And it's been like clockwork ever since. And so now what we're doing with this property is this property generates around $7,500 a year in net operating income. And we are valuing this property based on a 9% cap rate. So you take 7,500 divided by 9%, values this property at $84,000. You take 90% of that, because that's what we're selling, 90% is $75,000. And so my client is selling 90% of the equity in this property to limited members. And what it does, it allows us to practice cooperative group economics, allows an average person with just $500 to come in and to get a piece of the ownership, a piece of the net operating income paid out on a quarterly basis, and a piece of the profit on the back end when she eventually sells this. Benefit for my client. She gets her profit out now. She keeps 10% ownership, so she continues to get 10% of net operating income paid out on a quarterly basis, but she has 100% control over this property. But both her and the limited members' objectives are the same, right? To have a good quality rental that generates a stable income and where everybody eats and everybody is treated fair. So to invest in this property, you have to go through a crowdfunded site, and it's called Secure Living is the name of the company. And this is the web address. And I'll quickly take you to that web address. And I will also put the link in the chat. So the link is in the chat, and so you can copy that, and then you can go and view this at any time. But this is what the crowdfunding webpage looks like. Our goal is to raise $75,000. We're about 42% to our goal, and we started on Juneteenth, and we have through the end of September to raise this amount through the crowdfunding site. It gives you a snapshot. We're selling membership interest in the LLC, expect to be invested for 2 years, cash on cash return, 7 to 9%. Right now we're doing 8.5%. Payout period is quarterly, and our exit strategy is to sell. I'm not going to go through the rest of this, but here are the 2 important documents that you can download. So one is the pitch deck. The other is Form C. So Form C is what we file with the SEC. The SEC reviews it. It's a full disclosure of everything associated with the property and with the company. And then they approve it. So this is an SEC approved crowdfunding offering on a FINRA approved crowdfunding platform. And so this is for both accredited, non-accredited investors. If you are a non-accredited investor, there are limits per the crowdfunding law of how much you can invest per year in crowdfunding opportunities. It's generally limited to 10% of your annual income. If you are an accredited investor and you desire to invest more than 10% of your annual income into our crowdfunding offering, contact me directly. We also have a private placement offering that's running simultaneously. Through the private placement offering, there is no limit to how much a non-accredited investor can invest. And so we just have to make sure that you're a sophisticated investor. And that you understand the risks associated with investing in this specific investment opportunity. Any questions on what I covered regarding our first property and the strategy that we're using on selling the equity so that my client can go out and buy another property? You guys are a quiet crowd.
No question. I just wanted to say, wonderful, wonderful presentation. Understood everything, really great strategy. You understand the market, really smart. I love it. I especially like the fractional investment where the owner is still able to maximize, her investment and expand her portfolio at the same time. It's really brilliant. So thank you for doing this. I'm glad I could witness it.
Well, definitely thank you for joining, Deborah. And so Miss Harper is you want to give people a little bit about your background?
Well, I'm actually born and raised in Los Angeles. My mother also lives in the Antelope Valley, but I moved to Detroit in 2016 for real estate investing, and I'm a real estate developer here in Detroit. I can't come off camera right now. It's very late here. I'm ready for bed, so yeah. But anyway, so, I'm here, and, everything that you said about the market is pretty spot on, I also used to work for the land bank. So, your explanation of what the land bank does and, it's spot on. I mean, good. I like your areas that you're looking at. I like your intentionality behind it. You know, that property on your first property looks really good. It doesn't look like a slumlord property because, you know, really we want our people to be able to live in dignified housing, you know. So I like it, and I hope maybe we can partner on collab on some things. I'll be back in Los Angeles in September, so yeah, I like it.
Well, definitely looking at meeting up with you again when you come back to LA.
All right. Well, you guys have a lovely evening and be blessed.
All right. Right.
You too. Very nice meeting you, ma'am.
And Winnie, I know that you have been quiet, but you wanna say anything? Oh, Winnie. All right. So that basically ends our webinar. And I want to thank everybody for coming and viewing this. If you're watching it recorded, and Stefan, you can go ahead and stop the recording.